The government is preparing to tear up lending regulations imposed on banks in a bid to boost the economy through easier loans to home buyers and small businesses. The Rudd government introduced the laws in 2009 in the wake of the global financial crisis. The Treasurer is set to ease that liability imposed on banks, though, over so-called bad loans, shifting responsibility to the borrower. Joining me live now for more on this, Assistant Treasurer Michael Sukkar, joining us from isolation there. Thanks very much for your time, Michael Sukkar.
Good to be with you.
Essentially, the argument from the government is there's too much onus on banks and loans are being denied when they shouldn't be. What's going to be the effect on this? You'd assume there'll be some more so-called bad loans as a result?
Well, not necessarily, Tom. I mean, what we've seen over the last 10 years is the responsible lending obligations become more complex. There's now more than 100 pages of quite detailed stipulations that banks have to put in place, which means that they are taking a much more risk-averse approach. And ultimately, that doesn't hurt the banks. That hurts everyday Australians who are trying to get a loan for a home or a car, or for restructuring their own finances to assist their small business that has some interaction with their own personal finances. So, you know, the flow of credit in the economy is one of the most important things to ensure economic growth. If you've got constrained credit in the economy, then that's a problem. And we've seen over years, quite frankly, this problem get worse and worse and worse. And as the banks, as a result of these laws, become risk averse, we've seen Australians with their mortgage application times blowing out. So that is a problem. We also have other Australians who just cannot get access to that finance because ultimately the banks under these laws are taking a very risk-averse approach. So these changes are extraordinarily significant for our economy, and at a time when we need to turbocharge growth, encourage people to go out and invest and to borrow, this is the exact prescription that the economy needs at this time.
Look, you've got a lot of agreement from different people. The RBA has indicated something along these lines, a lot of people in industry as well. But at the same time, when you talk about increasing risk, I mean, that very word risk will mean some increased bad loans. What's your assurance about how low you expect that figure to be in terms of an increased percent of loans that go to bad?
Well, there's no... look, the Chair of the Reserve Bank made a very good point that, quite frankly, you need a portfolio from a bank's perspective that has some risk in it. Otherwise, you're not lending to people who deserve it. And banks don't have any interest, Tom, in lending to somebody who can't repay their loan. That's the first basic principle. And what we want to enable more here is for banks to make those assessments, and under APRA rules, they're still required to substantiate people's income and make sure that they're able to repay their loan. Indeed, it's in their interests to do so. But here we're pulling out ASIC, we're pulling out 100 pages of red tape to enable the banks and consumers to do that more swiftly, to ensure that they're assessing everybody on their own merits. I mean, the Treasurer wrote today in a wonderful op-ed in The Australian a circumstance of a recent widow who had $430,000 in the bank but wasn't able to get a credit card because under these responsible lending obligations, she was deemed to be at financial risk. I mean, that's just preposterous. We've got people who apply for a mortgage who are being asked how many coffees they buy a week. Now, in the end, those sorts of questions are being driven by the responsible lending obligations. They're not being driven by the ordinary assessments that you think a bank would take when looking to lend to somebody. So we're removing that red tape. This is, I think, going to be an adrenaline shot in the arm of the economy. And you're quite right, Tom. Industry groups around the country, individuals around the country, mortgage brokers who represent everyday Australians around the country are celebrating this announcement because it's going to make it so much easier to get the finance people need to do the things that they want to do in their lives, whether it's buying a house, a car, or supporting other activities in their life.
All right, and just finally, the MBA, Master Builders Association, is saying, yeah, good move, but what about a loan-to-value ratio of 80% before mortgage insurance is needed? What do you think of that? Could that be lower, the amount you need for a deposit?
Those are ultimately going to be questions for the banks in response to the capital adequacy requirements and other rules laid down by APRA. So here by removing the responsible lending obligations again, which is extraordinarily important. This is placing APRA in a prime position as far as these sorts of questions. And ultimately, I have some sympathy for what the NBA has suggested, but those are questions in the end for banks following APRA rules, because obviously when you're lending large sums of money, you want that to be secured, and loan-to-value ratios are of course one way that they secure their mortgage. So I'm not going to weigh into that. I think APRA is the right body to make sure that those rules are in place.
All right. Fair enough. A bit shorter than we aimed. We've got to go, but I'm sure you'll understand because we're going to the Treasurer, Josh Frydenberg. Michael Sukkar, thank you. Josh